Hello and good morning, North America, good morning, North America, good afternoon, Europe, and a warm welcome to listeners from around the world. Welcome to our Minds and Money 5 at 5 show, which today is sponsored by RK Equity and is brought to you in association with Resource Global Network. For those of you attending the 5 at 5s for the first time, our aim is to maintain engagement between investors and miners through a lively interactive format during the current situation. If you have any announcements before we start, please ensure to have your videos switched on, and to ask a question, you can ask them in the chat function below. For today's show, we have two fantastic panels and a really great lineup of guests, for which our host is Howard Klein of RK Equity. Over to you, Howard.
Thanks a lot, Andy, and thanks to Minds and Money for having this again. I'm going to start with just one or two slides. If you could go, Elaine, to the next. So RK Equity has been in this business of supporting the battery material space for over 10 years. We have a podcast and now a YouTube channel. So I'd encourage all of you to visit Rockstock channel on YouTube, subscribe, and check out the videos there. Next slide, Elaine. Every month we put together a lithium market scoreboard. So I published this on Twitter yesterday. I've highlighted in orange the three companies who are on this panel: European Metals Holdings, Savannah, and E3 Metals, which are lesser known than some of the others. Two of them are in Europe, Hard Rocks, that's European Metals, and Savannah. And one is a direct lithium extraction in Alberta, and direct lithium extraction has been gaining some traction in both Arkansas and Germany, and will do so as well, I think, in Alberta. But you could see in the middle columns there, the 1 month, 3 month, and year-to-date performance are all very substantially in green. That wasn't the case a few months ago, and there's been a lot of positive developments over the summer and into the fall, from Tesla's battery day and Tesla talking about mine more nickel and also talking about lithium, to Tesla's being included in the S&P 500, to Biden being elected, but having what I call a kinder, gentler gridlock, because it wasn't just uniformly there. But I think we'll have constructive policies out of the U.S. You've had Citibank and Canaccord kind of calling the bottom in lithium and upgrading stocks like Albemarle and Livent. There's been a lot of short covering in those names, as well as some others like Galaxy, Pilbara, and Orocobre. And overall sentiment has greatly improved and largely led by Europe demand. Europe is the new China. I also have my partner, Rodney Hooper, on this panel, who's going to be speaking a little bit about that. So I think it's timely. Lithium 3.0, as I call it, started over the summer. We've had a re-rating in a number of these shares. But the three companies on this panel, I think, are still, substantially, undervalued relatively, and have very interesting stories that your audience should pay attention to. And with that, why don't we start with the first, European Metals Holdings. Keith Coughlan will tell us about what is the largest resource in all of Europe, represented over 2/3 of the hard rock resources in all of the EU is in one deposit, and partnered with a Czech state-owned utility, ČEZ, so very strong partners. And over to you, Keith.
Thanks, Howard, and to you and to Andrew for having me on board. Thank you to everyone for tuning in. We're a little tight on time tonight, so running through quite quickly. The key features of our project, the Synovitz Lithium project, as you'll see on the slide in front of you. Firstly, and Howard mentioned, it's a very big lithium deposit, by far the largest lithium resource in the European Union, and about the 4th largest non-brine resource in the world. We've completed 2 preliminary feasibility studies on the project, and both of those demonstrate the ability to produce material in the bottom half of the global cost curve, be it either lithium carbonate or lithium hydroxide, both of which we have previously produced to battery grade standards. I have a slide in a moment that shows you the project on a map of the region. The location is very, very important. Within 500 miles of our project, there are about 6 million vehicles made every year. And every year, more and more of those vehicles are being made electric. As Howard mentioned, Europe has overtaken China recently during COVID months to be the largest producer of electric vehicles in the world. This is a demand scenario that we see increasing and increasing dramatically, with no current production of battery-grade lithium in Europe whatsoever. So coming off a zero base, Europe is going to be one of the greatest demand centres for lithium globally, with no current production, and with the emphasis we're seeing globally on developing local supply chains. We all have a lot of catch up to do in Europe to meet the demand criteria. Elaine, the final slide. Thank you. As I said, we've completed 2 preliminary feasibility studies on the project. The most recent was last year. The parameters of that project, of that study, are there in front of you. Very robust, a net present value after tax of about $1.1 billion US, and an IRR also post-tax of almost 29%. The ability to produce battery-grade lithium hydroxide, net of our tin byproduct credits for under $3,500 US a tonne, makes it a very compelling project from an economics point of view. And if we look at that in the macro conditions of what we're seeing currently in the EU, there's a very strong push within the region to develop green energy solutions for an electric vehicle future, for the development of the new European battery industry, and more recently the realisation that in order to do both of these things, you need to develop the local critical raw materials that are within the region. We've seen the development of the European Critical Raw Materials Alliance very recently, and all of these factors mean we have strong economic support, policy support within the EU to get Synvets to production. Howard, I think that's my 3 minutes.
Okay, thank you very much, Keith. And yeah, I just wanted to interject. So much of what I do and this panel here is focused on non-China supply for non-China demand. And increasingly, that is more lithium hydroxide focused than it is lithium carbonate. Lithium carbonate is more a Chinese, LFP technology when it comes to batteries. And Tesla showed during Battery Day that I guess kilogram per kilometer, right? The distance that molecules travel is very important. So that slide you were showing, you're right in the center of battery production. And likewise, Portugal, which David will show on Savannah, is very close to port and very proximate as well to the European battery supply chain. So your deposit, Keith, you mentioned tin is a past producing mine, for tin. So that's a zinnwaldite deposit. David's is a spodumene deposit, which has feldspar and quartz byproduct, which is actually exactly the makeup of Piedmont Lithium's deposit, which, as most of your listeners know, signed a supply agreement with Tesla, in September, for the Texas factory. So why don't you tell us, David, about why a similar outcome may be on the cards for you? Half joking, but over to you, David.
Okay, thanks, Howard, and honoured to be on this panel and sort of talking about Europe and lithium. So Elaine, thank you. Perhaps back a slide. Thanks. Yeah. I think a couple of sort of key things. We own the Mina de Barroso lithium project in northern Portugal, 100%. And I think the key thing is it's a conventional deposit. It's very much the analogue of the Australian spodumene deposits, which effectively underwrite something like 50% of global production. So as Howard so often says, this is a plain vanilla project, and it's a conventional project. It means it's a low risk project. It's hard rock. produces spodumene. It uses conventional processing that's been used by the mining industry for probably over 100 years. And spodumene itself is the most internationally traded of the minerals. The project is 27 million. It's the largest spodumene lithium deposit in Europe, 1.1% Li2O. It's very low iron material that's very appealing to the lithium hydroxide producers, and we should be able to produce something of the order of 25,000 tonnes of lithium carbonate equivalent per annum. Capital cost of the mine is around about $109 million US, and it shows the sort of outstanding operational economic characteristics with after-tax IRRs in the high 40% range. Next slide, please. Thanks, Elaine. Simple slide. The project's in northern Portugal, in the western part of Europe, and of course, as Howard was saying, Europe is the new China, and effectively the centre of gravity, if you like, of lithium globally has been swinging to the left and swinging to the west, and Europe really will be a very sort of major consumer of lithium on the back of EV production and on the back of a huge rollout of cell production capacity in Europe. Our project is in northern Portugal. It's about 140 kilometres from Porto, which is the second largest city in Portugal. It's close to the port of Porto, so it gives us access to the Atlantic and to northern European ports. Importantly, it's a real renewables powerhouse in the northern part of Portugal. Around more than 50% of Portugal's electricity production comes from wind and hydro, and will be preferentially powering our plant with renewable power. So our low carbon sort of green footprint will be very sort of key. We're close to market demonstrably, and it's important that we have production in Europe. Our European provenance is very important. It means that our mine development will be done in accordance with the very rigorous European and national environmental regulations that we're working to. As well as that, they're of course in accordance with European labour requirements. We believe it will be a premium product because it's sort of will enjoy very low sort of carbon footprint. I mean, this is not material that has to be mined in WA, shipped to China, processed, and then that upgraded material shipped to Europe. This is European lithium for European consumption. So effectively, that's the story. We believe that the northern part of Portugal, where our mineral tenements are located, will be a major lithium producing region of Europe. And we've started off with a 27 million tonne resource. We're shooting for 50 million tonnes, and we hope to be providing strong, reliable, premium lithium feedstocks to hydroxide producers in Europe, starting up in 2022 and 2023. Thanks, Howard.
Okay, great, David. Thanks. And yeah, as you saw, Portugal actually has some lithium production, as it is. There's no, hydroxide production yet in the continent. I think AMG is building something, in Germany, and there are talks in kind of Finland, but Portugal seems very well placed based on your resource to also be a hydroxide hub. So as the world needs, we always talk about, by 2020, by 2030, the world probably needs another 50, 20,000 ton hydroxide plants. Where are those going to be built? In Portugal, mine mouth, close to mine mouth, would seem to make sense, in chemical skills and the like, in the center of the continent, like with European Metals Holdings. And also our next guest in Alberta, Chris Doornbos. This is a DLE story. There is a DLE story that's geothermal in Germany that's had a lot of traction and mind share, and the stock has performed very well. Vulcan Energy, but Chris has been at this, a bit longer than they have, and I think meaningfully underappreciated for on a relative advancement perspective, and also I think perhaps somewhat less complicated in very oil-friendly Alberta. So why don't you tell us, Chris, about why you're the next DLE story to rise in the Mr. Market scoreboard?
Absolutely. Thanks, Howard. I think this picture tells a lot of that story right here. This is our project site in South Central Alberta. You can see grid roads located every mile. You have, on the bottom right, you can see an oil and gas facility. A lot of what we're doing for this project looks identical to oil and gas. We're building on the backbone of a sophisticated industry in Alberta. And Elaine, if you can go to a couple of slides. Yeah. So the competitive advantage for E3 is that we've developed a technology in the direct lithium extraction space. So we extract lithium directly from brines without the requirement for evaporation. We do this chemically. It's an ion exchange system. So to simplify it, it's just a water softener, except we're taking lithium out of the brine instead of calcium. And how this works for E3's brine, and the reason that we're able to make this project have the value that it does, is the efficiency of this process. So we're in the high 90s in recoveries. So we have very efficient, very quick reacting material. And what we end up doing is producing a very high grade concentrate solution. And regardless of the project, if you're one of the other gentlemen here on the hard rock side, you make a concentrate, a hard rock concentrate, or for us, it's the liquid concentrate. And then you refine that into lithium hydroxide. At least that's the direction we're going. And so our process, therefore, is very similar on one side of the oil and gas, and on the other side to conventional lithium processing, with this DLE technology in the middle. And when you look at this from the Alberta perspective, the white outline on this map is the location of the project. We're just north of Calgary. We've got 600,000 hectares of land, 1.5 million acres under tenement, 7 million tons of resource at our disposal. If you can go to the next slide. This is the process flow sheet in simplified form. If you were to fly over top of this project once we're in production, we would look just like oil and gas. If you're in oil and gas today, you're taking the fluid out of this aquifer, you're stripping out the oil, and you're putting the brine back in. As the majority of this aquifer is the brine, we just source the brine, we take the lithium out of the brine, and we put it right back into the reservoir, which means social license for this project, permitting for this project, all of the important factors to get a project off the ground and into production are streamlined because of the Alberta advantage. And a big part of that, for example, a well license, which is attuned to your mining license, is 4 to 8 weeks generally to get granted in Alberta. So the time frame for permitting is drastically reduced. We make a lithium concentrate with our tech, that's the lithium extraction box, and then from there, it's polishing and purifying into lithium hydroxide. We'll likely be using electrolysis, which is a similar process that most will deploy to make hydroxide. Our polishing step is where we have a huge cost savings. And that means that because we have a high pure concentrate coming out of our technology, we spend very little energy and effort cleaning that to get it to a quality that we can sell directly to battery manufacturers. We want to move to the next slide, please, Lane. And we recently put out a preliminary economic assessment. So a 20,000 ton per annum project for 20 years as an NPV. We'll go with the after-tax number of $820 million US dollars, at 27% IRR, and for all intents and purposes, a very low cash operating cost. And we've done that specifically. There's a bit of trade-off with the capital cost, but given the market and where it's going, we believe that that's a safe bet to have a short capital payout and security of that supply. And then we can build a robust project by having a low operating cost. And there's no credits for this. This is straight our operating cost. And so For us, the goal of the project is to get 20,000 tons up and running as quickly as we possibly can. Like I said, the permitting timeframe is fairly short, but we can scale this project to 150,000 tons in just the resource areas that we've developed. And that 150,000 tons will run for a total of around 35 years. So this has the opportunity to be a very massive producer of lithium hydroxide into the market. And likely Europe right now is advancing. This will likely be more North American advancement as we move to EVs, which we're now building in 2024 in Oakville. So that's great. Thanks, Howard.
Great. Thanks, Chris. I just want to mention you own both the technology and a huge resource in contrast to some of the other DLE stories that have risen in the charts here at Standard Lithium and also at Vulcan. So that's key. Rodney is going to talk in a minute, but one of our mantras in terms of keep it simple, stupid from a geographic perspective, but also again by 2030, if you need 50 new hydroxide plants, each one is like 20,000 to 25,000 tons. That's kind of the sweet spot. That's going to cost 500 to 600 million capex. Call it $30,000 a ton capital intensity. So your project kind of fits directly in that and is very scalable. And if you look at, you didn't show the map, but like Alberta is not, it's just north of Nevada, right? So if you could think about just the transport distances to gigafactories, in the U.S., it has every much as claim as North Carolina or Quebec or Ontario might to the North American supply chain. So
direct rail.
It's direct rail.
Yeah, all the way to anywhere in North America.
So Rodney, we'll chat briefly. I'm going to give a quick advertisement. Anyone listening here, please feel free to visit our website at rkequity.com and register your email if you haven't already, so you're on our email list. Rodney and I are putting a lot of stuff in the public domain for free, but not everything. Rodney has above market kind of forecast for EV take up, and differentiated views on hydroxide versus carbonate, some of which he could share with you now, largely driven by what he's seeing in Europe. So Rodney, why don't you just take it away and share some of your proprietary thoughts?
Thanks, Howard. So certainly in 2020, we started off with a hiccup with COVID. There were a lot of downgrades to EV forecasts, and what we're seeing now in late 2020 is that we're actually going to be up probably year on year for EV cells, and possibly even as high as 2.6 million units, up from 2.2, so a strong finish. Never really in doubt in Europe, in order for the OEMs to achieve the CO2 emission penalty targets of roughly 95 grams per kilometer across the fleet, they needed sort of slightly above 9 in EV cells penetration to meet that target. They seem to have done that. A couple might be slightly under, and why we are bullish and why we see above consensus forecast for EV cells in 2021, we have 4 million units next year, is on the basis that in order to avoid CO2 penalties in Europe and the adjustment in super credits and the exclusion of the worst 5% of the fleet falling away, European OEMs are going to need to have roughly about a 15% EV penetration next year. And if we see a recovery to around 13 million units in Europe for the year, then you could be almost close to 2 million EV cells in Europe alone next year. And then all the model launches in the US, that's looking like 550, 600,000. And then always the question mark is China. Europe is the new China this year. With that said, China is coming on very strong. If they have a very strong November and December, they could actually pip Europe to the post. However, their best-selling car at the moment, EV, is the Wuling Mini EV, which is smaller than probably your dining room table and has 9 to 13 kilowatt hour battery, but nevertheless qualifies as a full BEV. What are our expectations across the sector in 2021 in terms of demand? Well, Tesla has been ramping up its production facilities aggressively in China. They are potentially, if they can get the Model Y launched very early in 2021 in China, could be heading for 550,000 units of production, at least in China alone. And then they've got Giga Austin and Giga Berlin coming through, talking about 100 gigawatt hours of production in Giga Berlin for the new 4680 cell. And that leads us to why we are bullish on lithium hydroxide. Their choice for their cells, other than the short range Model 3 in China, which uses LFP, is to go for high nickel, and certainly for their future applications for the semi and the Cybertruck, which are heavier weighted vehicles where weight and energy density is critical. They have expressed that they will be going for almost pure nickel at some point in time, but always obviously will be needing some cobalt. So our expectation is that lithium hydroxide battery quality will be up, demand up 50 to 60,000 tons next year, and supply only 3 real genuine suppliers into that market for now. Hopefully that'll change in the future and soon. With Livent and Albemarle suggesting they'll be largely flat next year, it leaves you only with Ganfeng, and we see a tightness in that market from the second half of 2021, and likely an inventory build globally as battery cell plants, particularly in Europe, will be coming online in 2022. And on that front, it seems to be pretty clear that Europe is looking to be self-sufficient. If you look at VW, they're demonstrating how they are going to electric truck fleets to deliver batteries from LG in Poland and getting through to their EV plants. So it's likely, along with the European Raw Material Alliance that's hoping to get 80% of lithium sourced within Europe, or certainly along with friendlier countries, but mostly domestic, and the cells that cathode will likely fall into that mix soon as well. So we see that Europe is likely to give assistance across the entire supply chain, and we are expecting moves in lithium production and producers in getting financial assistance from Europe also in the near future. Not far behind that, I think the US, is waking up to that. So the US and Canada likely to look to source local production and cells in time as well. Howard, back to you.
Great, thank you, Rodney. I want to pick up on the points you're making about the European Raw Material Alliance and ask, I guess, both Keith and David, which are among the most advanced projects in Europe as well. So Keith, why don't you start? I mean, you're fully funded, I guess, to a final investment decision, maybe in 12 months' time. And in addition to if you could talk about your partner Ches a little bit, also your EPC, the very large SMS group, and if you and David could speak about you're both EIT, energy, relationships, and how you see. It's very fresh. I guess Marko Stefkovic, European Commissioner, is a Slovak. The European Investment Bank has been lending money for cathode production, for battery production, Northvolt and the like. If you could talk about, might we see sort of debt funding and other support for the mining and chemical processing industry? Why don't you start, Keith, and then David, if you could chime in as well, how you're seeing it from a partnership perspective and a government support perspective.
Sure, Howard. So as you rightly point out, we bought Czech government via the National Power Utility CEZ or CHES into the project at the end of February of this year. They injected about 30 million euros at project level, which fully funds the project through to the final investment decision that we expect in 12 to 15 months' time. So a large part of the work that needs to be done between now and then is the definitive feasibility study and the associated studies, the feed and what have you that go along with that. As Howard alluded, we appointed the German company SMS Group to conduct this role for us about 2.5 months ago. And at the end of that process, they would deliver us a lump sum turnkey EPC contract that will carry both process guarantees and product specification guarantees. And these are very important in the context of developing a project, for lithium. The offtake profile is very important to get funded. But that agreement with CHES, the partnership with CHES, has helped de-risk the project significantly. We also became involved with the EU via EIT, the European Institute of Innovation and Technology. I'll let David talk about that in a bit more detail, but we signed a similar collaborative agreement with that group in July, and they're very, very supportive and very helpful. Perhaps you'd like to pick it up from there, David.
Yeah. Thanks, Keith. I think the interesting thing about Europe is that there's really a top-down push by the European Commission to establish a sort of independent and reliable source of lithium raw materials and lithium-based feedstocks into the lithium value chain in Europe, and that's for a couple of reasons. One being, for the very good sort of geoeconomic reason of, the competitive pressures from elsewhere in the world, particularly from China. The EU is intent on sort of maintaining the competitive position and the financial health of the vehicle industry in Europe, because it's an enormous industry in totality, very big employer, and a lot of wealth is actually sort of generated from it. So it's that sort of geoeconomic aspect, but the European Commission is also sort of really looking to sort of provide a double boost, particularly to help the recovery of the European economy because of the challenges from the current medical emergency. And a lot of the money that is now being directed at the economic recovery will actually go into green initiatives, and some of that will actually go in the direction of lithium producers and groups in the lithium value chain. We see sort of tangible evidence of that support in a number of ways. I suppose our alignment, as Keith mentioned, with EIT InnoEnergy, they've been a brilliant partner for us, and helping to sort of chaperone us and our project around Europe. We've been working on a collaborative metallurgical program as well that was sponsored by the European Battery Alliance. And of course, we're seeing the EIB looking very sort of seriously at lending in this sector, and I think there are a few initiatives as well that might actually go into the equity side of the agenda as well. So it's a very warm and encompassing region to be doing what Keith and we are doing in Europe at the moment. And of course, at ground level, we're looking to secure offtake agreements with potential lithium hydroxide developments in Europe. That's a sort of a major missing link in the European lithium value chain. But I don't think that missing link will be missing for too much longer.
Well, as we've seen from Battery Day and post-Battery Day and Tesla getting into the lithium hydroxide business, that is a reflection that was also news on the tape. I think LG Chem is very significantly increasing their production in China. They didn't specify it was for Tesla, but everyone knows it's for Tesla. So I maybe you can comment if you had more inbound, I guess, post Battery Day, in the last kind of few months, vis-a-vis, I guess, paranoia from the likes of OEMs and battery companies on sourcing future supply.
In terms of what we're seeing, yeah, I think that's part of it, and I think another really sort of key part of it all too is the sort of the carbon footprint of the raw material supply as well. People like Daimler-Benz are sort of looking to be, I think, sort of carbon neutral in, I think it's 2035, something like that. But I think that will be across the board trend in the OEM sector. And they'll be looking very rigorously at their raw material sources and following that back down the chain. So the raw materials producers will all have to look at this really very hard and so demonstrate that they've got the right credentials, from an environmental point of view, and we'll all have to improve our sort of carbon footprint during the lives of our operations.
Okay, great. I'm mindful of time. I think we have about 2 more minutes, so I just want to bring in Chris from a E3 perspective. If you could maybe talk about, I know you've had a lot of seemingly Alberta government or academic support. You're applying for a grant. If you could just comment on the, I guess, the Alberta mentality toward, this, it's an oil province, the relevance of your project to the province.
Yeah, it's, I think, similar to Canada, looking to go back from
take off your video again, Chris. It's hard to hear you.
Sorry. Looking at supporting the project from a permitting standpoint. And I think that that's pretty important to building back a mineral industry for the province. There's not a lot of mineral potential. It's really only 2, us being 1. So it's very strong support post-COVID for developing minerals and developing green. And I think that shift, again, we'll likely see a lot of support on policy is mainly where I think E3 really needs it. In terms of growing the project is because it streamlines the development. And a lot of people talking about grants, and there are grants that we have applied for specifically that relate to these initiatives. It's obviously too early to tell if those come our way, but they are out there and available for us.
Okay, great. Andy, I'm just mindful of time. It's approaching 10:40. Do we have any more time, or should we wrap up from here?
I think we should probably, I guess, in the interest of time, I think we should wrap up and then just switch over straight away to our second set of 5 at 5 guests, Howard.
Okay, that sounds great. I'll just give a plug to all of the 3 panelists here. So European Metals Holdings is listed in Australia as well as on the AIM, ticker symbol EMH, and they have recently have an OTC ticker and are making progress toward tapping into the very significant demand from U.S. shareholders through I think a NASDAQ International or an OTC, QX listing. Savannah is listed on the AIM, the ticker symbol SAV, and E3 Metals is on the Toronto Venture Exchange, ticker symbol ETMC. And they also have an OTC in the U.S. ticker, both of which have experienced reasonable uptick in volume in line with my first Mr. Market scoreboard, all green, lithium bullish, outlook. So with that, thank you to all the lithium guests. Excited to have our next panel, which is on cobalt, graphite, and manganese. And thank you, Rodney, as well, who is signing off. as well.
Thanks, Howard.
Thank you. Thanks very much.
All right, Andy, so how do you want to play this? I think we're going to start with Trent Mell of First Cobalt. And I guess I had a nice intro with him earlier today. So First Cobalt's listed on the Toronto Venture Exchange, as well as, I guess, the OTC. The ticker symbol is FCC. .v, I guess, on the Venture Exchange. They are in Ontario, and they are actually focused more on midstream processing of cobalt sulfate, and is partnered with Glencore. So with that, I'll just introduce you, Trent, to describe a lot better than I can your exciting project.
All right, thanks very much, Howard. And yeah, indeed, our focus right now is the midstream. We do have exploration assets, not the focus of today's talk, but a fabulous primary cobalt deposit in the state of Idaho. So our assets, both mineral exploration assets and this refinery you see, are both in North America. And so it's an exciting time when you look at how EV sales have really picked up in Europe. Even those of us who follow it closely didn't expect 100% plus year-over-year uptick. And so as I sit here in Canada, our refinery just north of Toronto, you know, Biden presidency, they're going to sign the Paris Accord, the biggest consumer market in the world. And if we can come close to what we saw in Europe, then when America takes off, you know, that's a big passenger market. So the refinery here was built in '96, custom feed facility till about 2015, not operating. Why? Well, there's not a lot of there is no primary cobalt production and no real cobalt production of note in North America that could feed the EV market. So this is the only refinery. It's built, it's permitted, and it needs to be expanded. So we're going to repurpose it. And if you look at refining around the world, 80% of refining when it comes to the cobalt sulfate product that you see there on the left comes out of China. The other two, you've got Finland with the Kokkola refinery owned by Umicore, and there's a facility in Japan. So, you know, really, truly a unique asset. We have partnered with Glencore to bring this into production. Everybody does the same thing. The feed for batteries that comes out of the DRC. And so it's the same playbook until we get North American feed and until our battery recycling market is mature enough that we can do that at scale. Most or all of our feed is going to come from the DRC. So the relationship is with Glencore initially. They funded the feasibility study, small 60 million capex, and operating cost that's competitive, very competitive with the Chinese refiners. And the relationships evolved somewhat. We're going to be, you know, I would say maybe buying half our feed from Glencore, the other half from one of the other big commercial producers, and then facing the market doing our direct OEM contracts ourselves. So Elaine, the next slide, if you would. Thank you. So look, to be successful in cobalt, you gotta have a strong ESG mandate, and so that comes in two forms when you're talking about this commodity, and when you're facing the DRC. The first one, and it's highlighted a bit at the bottom right, is with respect to just transparency of your supply chain. You've got to be doing ethical sourcing. So we're members of the Cobalt Institute. We're going to be certifying this refinery under the RMI, the Responsible Cobalt Initiative, which is what the Samsungs, Teslas, and VWs of the world expect. So, you know, we're not buying from traders, we're not buying from artisanal miners, which is its own discussion in terms of how you do that right. But our position is we'll buy from the two of the biggest mining operations in the world, so that you don't have that reputational risk to the brand. And then you overlay that with just, you know, a good environmental footprint. And so we did a life cycle assessment of our facility. We benchmarked ourselves against the Huayo facility in mainland China. And, you know, we came out of there with flying colors. And it was representative of a lot of the Chinese facilities, which, you know, they're on a coal-powered grid. We're on a hydro grid. We've got a number of attributes, lots of water available to us. But our footprint is low, and that matters. Why? Because this product goes directly to an end user, directly into a battery that then finds its way into your iPhone or your VW ID3 or what have you. And so they care because our environmental footprint reports into their environmental footprint, and there's always this push to drive it down. And I think we're on our way to being the greenest, I would say the greenest cobalt refinery in the world. And if not the greenest, we'll be darn close, and that's aspirationally where we want to be. And then the last slide, just to wrap it up, just to show you what does it all mean for us. Good margins. We've got the assumptions listed at the bottom of that pie chart. So most of the top line revenue goes to buy the feed. That's the 218 million, but with 35 million in margin per annum at these assumptions, we're assuming a long-term $25 cobalt price. If you want to see where we are today at spot in a recovering market, our margins might be 20 million US dollars. But that annual margin at $25 is equivalent to our current market cap. So that doesn't even begin to speak to our mineral assets. You can apply a multiple of that as an operating entity. So from us, I guess you'd expect us to see us sign some feed contracts in the next few weeks, Government support should not be far behind. Our financing in Q1, and then we expect to commence our expansion around June. So 12 months after that, we commission. So small CapEx, pretty small execution risk, and a pretty quick path to cash flow. So I'll stop there, Howard.
Okay. And so now we have Paul Gill of Lomiko Metals, which I think is a graphite or graphene in Quebec.
Actually, like, sorry, Howard, we've actually got a few questions from the audience for Trent first. Is we just have like Trent ask, if I can just ask a couple of the questions that come in from the audience.
Okay, go ahead.
Yeah, sure. Yeah, sorry. Yeah, so there's a question that was sent in by Leslie Watson, Trent, which was a question regarding your Idaho site. Is additional exploration planned for the site?
Yeah, absolutely. We just finished a geophysics campaign. Cobalt was, we started the company in 17, and Cobalt went on a fantastic bull run and attracted lots of shareholders, lots of capital, and we were able to bring a number of fantastic assets together. We stopped drilling in late 18 as the market went south because, frankly, the market's not going to reward you. It's expensive, but we've got, inferred and indicated resources of almost 5 million tons. I'd like to see us double that over the next couple of years. So geophysics, we just completed to extend our resource. It's on private land, patented property. If the market continues to improve the way I've seen it, the cobalt market improved this year, even with the cobalt blip, you should expect us to be drilling there again next summer.
Okay, and then there's just one more question that's been sent in by the audience as well, referring to your Canadian cobalt camp and the recent high-grade silver and cobalt intercepts. It's about like, where does the future value of First Cobalt lie, within silver or within cobalt?
Yeah, we've got three great assets, and when you rank them, cash flow in the refinery has to be job one, because that will reduce or if not eliminate our reliance on the capital markets over the next little while. Then Idaho has to be number two. It's primary cobalt. Every drill hole is mineralized over 10, 20, 30 meters. So cobalt camp, I still believe in it. Bonanza grade silver, bonanza grade cobalt. At these prices, it's more of a silver camp. So we've had a lot of people banging on our door. You might see us try to do something with that camp to raise value. We're a motivated seller, but not a desperate seller. So if I can help use that to leverage value to advance our refinery, we will do so and try to remain involved in some level, JV or otherwise, keep the exposure. So we're working actively on that, and I would say stay tuned on that front.
Okay, thank you very much for that. I think if we haven't got any more questions for Trent at this stage, if I can just hand back to Howard just for the next presenter.
Okay, great. Thanks. Paul Gill of Lomiko Metals. Why don't you go ahead?
Hi, Howard. Can you hear me okay?
Yep.
Great. Elaine, if you could put up our December PowerPoint. Thanks everyone for attending, and I appreciate your time. Lomiko Metals is trading on the OTC under the symbol LMRMF and in Canada under the symbol LMR. We primarily are working on a graphite deposit called La Lutte in Quebec, and we're following in a tradition of a number of different graphite projects that have been brought upon and raised in the last little while. One is Mason Graphite under the symbol LLG, and the other one is Nouveau Monde under the symbol NOU. So we have I think a very good situation in Quebec, very supportive government, and we plan to proceed with our development. We're currently completed all of our drilling and starting towards a preliminary economic assessment. Of course, if people aren't aware, the graph on the screen will show you the kind of demand that there is for graphite in the next little while, along with the other metals in the industry. Next slide, please. So what is very interesting about graphite is there are a number of different grades and gradients of the material and carbon purity. So there was a number of different markets, of course, for these particular materials, and the most important being, for our purposes, the spherical graphite market that is serving the electric vehicle and nuclear battery industry or nuclear industry. So these particular types of materials, we extract flake graphite, convert it to spherical graphite, and then coat it in order to have it usable in a graphite anode. So there's a number of different, in any deposit, there's a number of different potential revenue streams. Next slide, please. So where are we located and why is it important? Infrastructure is very, very important to any mining project. We're located about 100 kilometers from the Port of Montreal, which is an international port at the St. Lawrence Seaway. It goes to Europe and to the east coast of North America. It's a fairly large property, 2,800 hectares. We've completed all of our drilling in 2 particular zones. We've also have another property that is adjacent to the Imerys Timcol mine, which is about 50 to 60 kilometers north west of our location. The key for our particular project is near surface mineralization, meaning low economic cost of extraction. It's an open pit, and currently we're on the way to owning 100% of it and writing a preliminary economic assessment. So next slide, please. So here's our latest and I think some of our best indicators of the kind of viability of this particular project. What we see here is a very extensive mineralized zone that extends over 900 meters. We've had several intercepts of well over 10%. There's too many to name. Important also is the fact that there is a lack of sulfur impurities, which is a detriment to mining sometimes. And we're now planning on an updated 43-101 metallurgy and preliminary economic assessment. So we're a small market cap company with a very good potential in the next little while. So thanks very much, Howard.
Thank you very much for that. We've actually just got a few questions I'd just like to ask. Trent Mell talked about the impact of the US Biden presidency on his company. What would be the impact of the US Biden presidency on your company, Paul?
Yeah, I think the key element here is that there is zero graphite anode production in North America right now. And so that's been identified as a huge problem. We think that definitely the trend, whether it was Trump or Biden, was towards making critical metals an important aspect of any kind of rebuilding of North America and America. There is linkages now established between Canada and the US on critical metals. There is, in fact, we participated in a seminar recently that had these linkages identified and both representatives from the Canadian and US governments involved. So that trend is afoot. We need many more mines of lithium, cobalt, and graphite here in North America in order to be a viable player in the electric vehicle industry, and in fact, many other clean energy plans that are afoot in America and the US and in Canada.
Another kind of question is, you mentioned earlier in your presentation about Mason Graphite and Nouveau Monde Graphite. I know when I talk to investors, they often sort of struggle to sort of differentiate between the USPs of one good graphite project from one to another. What are your particularly unique selling points with regards to your project versus the other graphite projects which investors listening into this program might be considering?
Yeah, one thing to remember is that we need at least 5 new graphite projects in North America alone in order to even meet any kind of demand. So that's the first thing. Secondly, I think one of the things that we have identified in our particular location is a nice balance between the lack of sulfur in our particular project and the fact that there's high grade graphite near surface. Our nearest, I think, example of a viable mine is the Imerys carbon graphite mine. Geologically, it's the most similar to the project. How it compares to other graphite projects, Nouveau Monde and Mason, I think we're just located in the right spot. We're in a Goldilocks zone near a major producer, near a port, And we don't have to build a port. We don't have to worry about some of the things that some of the other companies do in remoter locations.
Sure. And then just one final question for you is, I saw that you've sort of set up I think a sustainability committee a few months ago. In terms of the investors that you're looking to attract, is it, I guess, traditional natural resource investors, or are you also looking to reach out to ESG funds and to millennial investors that may want to be investing into the green story? And if so, how are you going about doing that?
Yeah, I think we have a multi-pronged approach. Obviously, there's traditional mining investors that are going to want to be involved in these kind of developments. But however, as mentioned before, all of the major producers of electric vehicles have technical committees that require the sourcing of the materials to be in a clean and energy efficient way. So definitely establishing that particular committee indicates our need and our desire to qualify to be a supplier to those particular projects.
Thank you very much for that. I think in the interest of time, I'm now going to hand back to Howard to introduce our next presenter.
Okay, great. I think it's David Sachin in Ivory Coast who's going to tell us about EV Magnatech, a manganese story. Go ahead, David.
That's me. That's Sachin. It's not David. Thanks, Howard.
I'm sorry.
I want to introduce EV Magnachem. That's our manganese-based EV battery specialty chemical to be used for EV battery producer. We have been producing manganese ore in Ivory Coast since last 15 years. We are a mid-size mining company producing about 500,000 tons of manganese ore of medium and high grade. We also produce some quantity of natural manganese dioxide, which we have been selling to dry zinc cell batteries. And just last month, we got approved by Panasonic to accept our natural manganese dioxide for the dry zinc cell battery also. So on the manganese side, we are among the lowest cost manganese producer globally, among the lowest lowest cost manganese producer globally. And we are doing a forward integration, trying to get into manganese chemicals, which is used for battery production. So we have selected Qatar probably as our next destination, where we will put up the plant to produce manganese metal as well as manganese sulfate. And can you please change the slide? The reason why we have selected Qatar, because Qatar offers cheapest electricity in this zone. It has cheap gas and sufficient sulfuric acid, a natural port, and the free zone within the port area. So we intend to have the roasting part, the calcination part at the mines in Ivory Coast, where the volume of the ore reduces by 20% when you get rid of one of the oxygen. So each product, if you see on the right of the slide, we are making 5 products: manganese oxide, manganese sulfate, high purity electrolytic manganese metal, and high purity electrolytic manganese dioxide, and then finally the manganese sulfate monohydrate. So each of these products are precursor or the raw material for the next one till you reach the final product, manganese sulfate monohydrate. So our focus always is low capex and high return. So we have already invested $6 million in the manganese oxide furnace, and we should be able to commission the furnace within the first quarter of 2021. So the profitability from manganese oxide will be replowed back to invest into manganese sulfate. The manganese ore mining business has been consistently making profit for the last 15 years. Every year we generate a cash profit of about $20–25 million. On a good year, we generate a profit of about $30–35 million. So with this value addition, we are going to change the product value from a $150 product into a $400 product just by doing the reduction at the mines itself. There is no mines in the world of manganese which is doing reduction right at the mines. All the manganese is transported from different mines globally into China or into India, and they do the further reduction at the plant level. That means all the arbitrage on transportation we will capture at our mines. We have already been selling to these clients for the last 10 years, so we know our ore is suitable. We have done our testing in the lab, and the first furnace will be ready by first quarter of 2021. That means just 3 months from now, and civil work is in full swing at the site. Once we produce the manganese sulfate, the manganese oxide, we are going to transport the reduced manganese oxide to Qatar, and here we are going to chemically treat it with sulfuric acid and further to do electrolysis and make one of the cheapest manganese sulfate globally, because Qatar offers very cheap sulfuric acid because of a byproduct from petroleum refinery, very cheap power, and also manganese metal will be much cheaper than even the costs in China. Somehow I feel the global industry gets sometimes scared about costing and production cost within China and outside China. So we have been producing manganese ore among the cheapest in the world, and we are very confident to produce the other 5 chemicals also among the cheapest cost and the finest quality. Can we change the slide, please? If you look at EV battery, we can see that this is from a battery material review, that there is about $50 billion of investment going into new battery capacities, another $60 billion going into electric vehicles, just about $8 billion going into raw material for battery chemicals. And within this domain, there are about 4 players who are trying to come up with manganese sulfate monohydrate, which will be used for EV battery. And among the 4 players in the manganese sphere, I would say that we are quite confident that we will be among the cheapest and the fastest into production line, because we don't have to get into manganese ore production. We are already producing since last 15 years. We understand Africa. We have been exporting consistently every month. Our product has been accepted over years with all these producers who are already producing these chemicals in China and in India. So by doing value addition, we are not only going to add value to our own product, but also we will be able to produce this at a lowest possible cost. The last thing I want to add is all our projects is based on low capex and high returns. So when we invest just around $6 million, we expect to generate a profit of about another $25 or $30 million additionally just by selling manganese oxide. So these 2 products, manganese ore as well as manganese oxide, these 2 products are going to further add on the profitability to infuse into manganese sulfate project. The company is sitting on sufficient cash. The company doesn't have any bank line, no borrowing, no debts. So we expect to get into the full capex also with our own capital infusion. However, we are looking at inviting and valued investors who have some experience on EV market, EV battery sphere, because they have the know-how, they have the market intelligence probably better than us, and it will add on reputation for the company to go with them in the stock market. We are producing about 500,000 tons of manganese ore, but our first phase will use only about 150,000 tons of manganese ore. So we have room for expansion to 3 times the capacity after we have stabilized the first phase of production of manganese sulfate monohydrate. So we have finished our lab test. We have successful till manganese sulfate level. On the electrolytic manganese metal level, we are supposed to reach 99.9% purity. We have been able to reach 99.6% purity. We are still struggling to reach the final leg, and tests are going on in the lab. I expect to achieve some positive results by next month, and then we can go into the feasibility study as well as the detailed project designing for the EMM level. We are now on the final stage of awarding the feasibility study as well as detailed project designing for the first manganese sulfate level, which we expect to be ready by the time we are in production for manganese oxide. So our project is a low capex and high return project. Can we have the last slide, please? This again talks about the demand and supply. if you follow the battery day announcement by Tesla, Tesla has announced that they are going to increase the manganese content in all their batteries, because among all the 4 elements which goes in the battery, manganese is the cheapest. So with high purity manganese, companies can reduce the cost of battery per vehicle. So we are in the right zone, I feel, because there's going to be huge demand for manganese-based chemical to be used for NCM batteries. And among all the different types of batteries, NCM batteries is the greatest player now, which should take up among all EV battery. Next slide, please. That's it. Thank you.
Okay, thank you very much for that. I think just time for like one question before we hand it back to Howard, just to ask a couple of questions to all 3 of the panelists. I think you mentioned at the start of your presentation that you're a privately owned company. Do you have any plans to go and take the company public in the next year or 2?
Sir, among the audience, we already have one of our advisor to the board, Mr. Rajat Kohli. He was a director in Standard Bank, and he is going to represent us in London. And he has been a banker for decades now, and he is going to take that part of our responsibility. And we will be focusing with our team on the project side. So, because we want to do the project within 18 months on the ground, so I will be more focused on the ground, and Rajat will probably take over on the London side to list it by next year.
Okay, sure. And then also just like one last question before I hand back to Howard is, you say that you're obviously getting your manganese from Ivory Coast. What is Ivory Coast like as a mining jurisdiction?
I feel Ivory Coast has earned more of a bad reputation than the actual area how it is. The fact that I've been mining 15 years in Ivory Coast, and I have had no problem. The government is very supportive. And I would say that we do a lot of community level social work. So every year we are building up schools, and we have adopted about 15 villages, which falls within our mining permit. So if you do social commitments and you perform with the villages and you blend yourself with the local community, I don't think there is an issue. We don't work there as a foreigner. We work there as they themselves. We blend with their culture. So it's 15 years now. My 1/3 of the life is spent in Ivory Coast. So I would say that I'm half Indian and half Ivorian.
Okay, thank you very much for that. I'd now like to hand the floor back over to yourself, Howard. We've got about like 10 minutes to go. I'm obviously keen for your thoughts on all 3 companies, and whether you've got any specific questions for any of the 3 presenters.
But I'll speak to Trent at First Cobalt. I guess you're partnered with Glencore. Glencore just signed a deal with Tesla. There's all this talk about trying to get cobalt out of the battery, largely because of DRC related issues. But battery day, I think he called cobalt in the bookend or the glue or whatever it was. So could you just help us understand why cobalt is still very much needed in high nickel content batteries, and why you're in North America, there was a very significant push, on the lithium side to reduce the distance, a kilogram per kilometer. So just if you just talk about those issues surrounding cobalt, and then Paul, I guess you're in Quebec, a jurisdiction that Pallinghurst is invested in, Livent is investing in, and has very much policies toward propulsion Quebec. And actually, Trent, you're close to the I guess the Sudbury nickel smelters. So just like this proximity in North America, if you guys could just talk about that as relevant for your projects.
Sure. Yeah, there's a lot of investment going on in North America right now. We don't hear as much about it as we do about Europe. But look, the short story is the Western world wants range, right? We hear about range anxiety. And if you want range, you need energy density. If you want energy density, you need a lot more nickel in your cathode. And guess what? If you need nickel, you need cobalt. Cobalt plays a stabilizing role in the battery. It prevents the thermal runaway risk that causes the battery to overheat. We've felt it in our phones and ultimately catch fire. And the other piece is the life cycle of the battery. You want those cycles. You want a 10-year warranty in your battery. And the degradation that goes on in a battery is mitigated just by the stability of cobalt within the chemistry. So what we're doing, the cheap batteries, if I may, the entry-level Chinese batteries, batteries, you don't have nickel or cobalt. You can have lithium iron phosphate, but the rest of the world, you need the nickel, you need the cobalt. And what we're trying to do though is get more nickel to get the range. And how do you lower that cobalt content so that you can protect the battery, but still keep the integrity? So that's where we're moving. And projections are still quite strong for cobalt. The growth rates outstrip any thrifting that's going on in the cathode today.
Okay, and Paul, if you can just comment, I guess, on Quebec as the propulsion Quebec and that IQ has been supportive in investing in a number of projects.
Right, Howard, and it's very important to advantage to be in Quebec because you have Investment Quebec supporting projects. They pay after a PEA has been delivered. They usually get involved to about the extent of 20% of the cost of the build of the mine, which is very important because these are large projects, and you do have groups such as Pallinghurst, as you mentioned, coming in and supporting some of the projects already, and we anticipate more will be attracted to projects in Quebec. So we absolutely are loving it so far, and I think that we're going to see some advantages going forward. It's early days, and the infrastructure will be built up, the mines will start, and the opportunities there.
Okay, and Sachin, I don't know a great deal about Ivory Coast, but I know from a U.S. perspective, there was some push, and they named a few countries, including Mozambique. And there are kind of government agencies, just in general, the critical minerals. The world is to some degree aligning with like kind of China and non-China. A lot of Africa is very much destined for China, and China's been very active in the Belt and Road Initiative with a number of African countries, among others. So could you just talk about that dynamic in Ivory Coast, that perspective from I guess a non-China supply, versus a China supply?
These are all strategic political decisions in terms of alliance or some kind of world over dominance, China and non-China. But as far as a mining company goes, they have a clear mining code, and they follow a mining code, and we have to follow the terms agreed in the mining code. So the mining code allows you to mine as per the normal structure, which is there in most of the companies, from typically exploration and exploitation and those things. So since it's already a producing mine, it's an exploitation permit since last 15 years. So we don't have any issues in terms of Ivory Coast as such. Our challenge would be to basically achieve from 99.6% to 99.9% purity for EV battery. That's the last bit of challenge left. But other things I think we have sorted out. And the most important is when you make the upside itself in Ivory Coast, you gain a lot in terms of value for the whole project for the shareholders.
Right. And I know there's another project called Manganese that's done very well post Battery Day because, Elon Musk on his, he showed kind of, LFP batteries, then manganese, nickel batteries for the what we call the sexy cars, the S, X, and Y, whereas the super massive nickel will be the Cybertruck. But it did raise the attention for high purity manganese. So good luck with your listing, in London. I think you should have some tailwind on the forgotten battery metal.
I want to add one point here that in the battery space, in the manganese, we are the ones who have a high grade manganese supply from the mines because it is our own mines. And among the pure value, they start on very low grade. So our cost of raw material is just about $26 million compared to about $100 million odd for the other pure value because our mines is captive mines. So we are basically doing forward integration using the highest quality control from the mines till the final product. So we are very confident to save on the cost of manganese ore and then provide the right product to make the manganese sulfate monohydrate.
Great. Okay. I don't have more questions, Andy. So
okay. Well, yeah, so I think we're kind of getting to the end of the 40 minutes. So I think if we've got no more questions from the audience, I think that all that remains me to do is obviously, first of all, thank our three guest companies. First, Cobalt, who I'm right, if I hope I'm right in saying their ticker symbol is FCC. Lomiko, which is LMR, and Magnachem, which is of course private. All three of those companies are also exhibiting at this week's Minds and Money. So you can go log on online and go and visit their virtual booths and have one-to-one meetings with them. And I'd also like to thank Howard Klein from RK Equity, who's been an excellent moderator for this session. I'd also once again like to thank the Resource Global Network, who've been supporting both these 5 at 5s today. Our next 5 at 5 show will be in about another 8 hours or so's time. So those of you who are those of you who are coming along to that, I look forward to seeing you then. In the meantime, thank you very much for your time. Thank you very much. Bye-bye.
Thank you, everybody.
Thanks, Andy.